Good morning, it's me, Kenny Polcari, your host of the party. It is day 2 up on Cape Cod. Today is Thursday, July 6, 2023. And what is it that we need to know today? Well, apparently the Fed minutes came in more hawkish than many expected, although I wasn't really surprised, and neither should you have been. But now the question is, will rates rise beyond September? The algo's go into sell mode because apparently they haven't been listening at all. There's lots of eco data out today and tomorrow. What will we learn that's new now? And Gigi takes retaliatory action against Joey. That's going to be very interesting as these conversations heat up. And the global markets around the world are under pressure. And what do we have for dinner tonight? Well, it's not dinner. It's that classic watermelon tomato salad that's always a summertime favorite. Okay, look, stocks fell. Doesn't get any more complicated than that. Remember last couple of weeks ago, we talked about that trees grow to the sky comment? Yeah, well, guess what? They don't. Yesterday, the Dow gave back 130 points or 4/10. The S&P fell 9 points or 2/10. The NASDAQ lost 25 points or 2/10. The Russell choked, falling 24 points or 1.25%, while the transports gave back 88 points or 6/10. Wasn't a disaster at all. So don't go screaming disaster. The markets just fell. And they're lower today. Factory orders coming in at plus 0.3%, which was less than the plus 8 expectation, although durable goods did beat the expectation, coming in at 1.8% versus 1.7. Capital goods ordered, capital goods shipped came in as expected, but it was the 2 p.m. Fed minutes that really set the tone in the afternoon and is setting the tone around the world today. Global markets are under pressure and U.S. futures are pointing lower, but we'll get to that in a moment. And while I would say we did not learn anything new, I guess the smart logic algos thought differently. And they didn't like the headlines, right? Sending stocks lower. Remember, smart logic algos, they scrape headlines from everywhere they can find them. The paper, Twitter, LinkedIn, wherever they find them, right? And then they react based on what the headlines say. So positive headlines cause the algos to go into buy mode. Negative headlines cause the algos to go into sell mode. And yesterday, the headlines were decidedly negative. So for instance, Fed officials expect additional rate increases while tempering expectations of any rate cut, right? It's not a disaster. And by the way, that's nothing we didn't know already yet. It isn't what, isn't it what J.J. Powell and other members of the Fed have been saying all along? Yes. Is there anything new in that headline? No. In addition to that, the staff at the Fed has now officially predicted a recession, although they didn't define the extent of it, only that the starting point remains elusive. Recall that in the spring of 2022, 4 months after the yield curve inverted, nearly every street economist was projecting a 12 to 16 month time frame for the recession to hit, because that is the historical time frame average. And that time frame pointed to February to May of 2023. Well, now we're in July of 2023 and there's no recession, which is causing some investors to suggest that when it does come, it will be harder and longer than expected versus the shorter, softer prediction that maybe others had been hoping for, right? So that's still out there and we have to figure out which way we're going to land. Now, the news also confirmed that the markets are now pricing in a definite 25 basis point rate hike in July and most likely another one in September. Again, that's not new news if you've been paying attention. But it did cause the trader types to all run for the door as they try to lock in profits ahead of what now looks like a more volatile summer and into fall, which is usually a volatile time of the year anyway. But again, I say this is nothing new here. So as a long-term investor that has a well-diversified portfolio, there's nothing for you to do yet. But if you're a day trader, there is always something for you to do because that is what you do. You react to every minutia detail. Long-term investors do not. The question now becomes, okay, rates going up, great, but for how long? And when they get to the 6% terminal rate, which Cleveland Fed President Loretta Mester and Jimmy Bullard, St. Louis Fed President, and Neil Kashkari, Minneapolis Fed President, have been floating for months now, you have to ask how long will they stay there before they decide to cut rates, assuming that the next move is going to be a rate cut. Remember, the clowns that told us the Fed would raise until June and then begin to cut rates in September, which never made any sense to me at all, leaving rates down 75 basis points before Christmas. Yeah, well, that's not happening. And especially after yesterday, that is not happening, right? I mean, just go back and read the minutes. All you have to do is look at the headline. Look, we'll be lucky if we get a rate cut before the summer of 2024. And so the markets are now reconsidering the valuations, right? Which are stretched, to put it mildly. And stretched valuations do come under pressure, the same way trees don't grow to the sky. We just need to figure out how much pressure they're going to come under. And do not discount the idea that the pendulum always swings too far to the left as an overstimulation for way too long, which we've talked about. And now it's going to probably swing too far to the right as an over-tightening. And that's going to cause the recession to hit. Just depends on how far to the right is going to determine the extent of the recession. Now, there's a lot of economic data today, and that's going to help set the tone as well, right? Mortgage apps were out at 7 o'clock. They fell by 4.4% as mortgage rates teased 7% and likely now going higher. Challenger job cuts came out at 7:30. 8:15 this morning brings us the ADP employment numbers, which are expected to show an increase of 225,000 new jobs, not what JJ wants to see. At 9:45, we're going to get S&P Global Services PMI, which is expected to come in at 54.1, solidly in expansionary territory. At 10 a.m., we're going to get the JOLTS job openings along with the ISM Services PMI of 51.2. Still expansionary, but closer to the 50 neutral line. And all of these data points become even more important after yesterday's Fed minutes. But it will be tomorrow's non-farm payroll data that is the real driver. The Fed needs to see job creation decline. They need to see unemployment increase. They need to see wage growth decrease. But is that what the report is going to show? So stay tuned till tomorrow. In any event, global markets did not like what the Fed had to say, and it only confirms what the other central banks around the world have also been saying, right? We remain hawkish and rates are going higher. In addition, news that China is now striking back against the Bidens is also not helping the tone in the tech space. Recall that Joey's restricting exports of AI chips to China for fear they will do something bad, which is laughable. Fear that they're going to do something bad. I mean, come on. They already used American-made technology to spy on us via that weather balloon. Remember that? And now China's restricting exports of gallium and germanium, which are chip-making minerals, right, produced in China, mined in China, and those are needed to make the chips. And they made it very clear that if Joey doesn't back down, then they're going to ramp it up even more. It's a classic tit-for-tat reaction, and I guess you can't blame them, since they produce those minerals needed for chip production, right? So you're seeing where this is going. Now, toss in the ongoing, we're going to take Taiwan threats, and you can see how the world can change in a minute. But you have to ask, whose fault is this anyway? Who gave them the power? We did, right? Now, Asian markets ended the day lower. Hong Kong was down 3%, Japan down 1.7%, Australia down 1.2%, Taiwan down 1.7%, South Korea down just under 1%. China services sector slowed more than expected in June, or at least that's what they tell us. I don't believe anything China says. European markets are also down more than 1%. France is losing 1.7%, Eurostock down 1.4%, FTSE's down 1.3%, Germany down 1.1%, Italy down 1%, Spain down 0.9%. Recall that Eurozone PMI figures yesterday also showed a slowdown across the region last month. And this morning, U.S. futures are lower. Dow futures down 150, S&P's down 20, NASDAQ down 80, and the Russell's off 14. UPS is getting whacked as contract talks have stalled, and that threatens a Teamster strike that would not be good for the U.S. economy. Remember, the contract talks are all about what? Wages and benefits. And the Teamsters want more of both. Kavish? And that's going to be a problem if they go on strike. Now, in addition, the fact that the Fed has now officially forecast a recession, and I say officially because prior to this, they kept telling us that we could avoid a recession. Now they're saying, can't avoid it, it's coming. And that's bad news for risk assets, think stocks, right? Look, the Fed just said it. They are forecasting a recession while also saying that they intend to raise rates at least 2 more times. So the S&P is priced at 20 times forward earnings. It's going to have to adjust downward. Look, it's a math problem. That's all it is. But think about those sectors that are trading at multiples much higher, right? Does tech ring a bell to you? They're going to adjust much more if, in fact, that we hit that recession and broad S&P valuations decline. Which leads me to remind you, What have I been telling you? This is not the time to add to tech. And any new money can be put to work in the underperforming defensive sectors like healthcare, financials, consumer staples, or even short duration bonds. If you are overweight tech, you want to bring it down and inline either by putting new money into the other sectors or trimming just a bit of your tech while maintaining that core position in those mega tech names, right? Reallocating that money, the money that you raise, into the more defensive sectors. I'm doing the opposite. I'm just putting new money into the defensive sectors. I'm leaving my tech alone because I have all names that I want to own. Oil traded up higher, up and through trendline resistance yesterday, which was at 71.30, and this morning is now on the north side of that, trading at 72.12. Guess why? Tighter supplies. Recall that Saudi and the Russian production cuts for July and now August, as well as a more aggressive China. Never mind the ongoing demand here at home, even as JJ tries to slow our economy. We're now in the 71.30, 73.60 trading range. A test of 73.60 is going to prove to be tough to get through unless OPEC gets even more aggressive with production cuts. Remember, they want to see $80 plus a barrel. Gold remains in line, trading at $19.30 an ounce, and I suspect it's going to remain in that $1900, $1975 range that I identified a couple of weeks ago. The next hurdle for the markets is going to be the start of earnings season, and that officially begins next week on July 14th. Expect all kinds of pre-announcements and analyst revisions in the days ahead leading up to the earnings season, right? The S&P ended the day yesterday at 44.46, down 8 points. Not a disaster. Yesterday, I said, do not be surprised to see a pullback ahead of the start of earnings and ahead of yesterday's Fed minutes. We were expecting the minutes to reveal higher rates in the coming months, and that's what we got. The surprise was, what will the Fed do next beyond September, suggesting that we could see higher rates in October and maybe even November as well. Remember what I said, the pendulum swings too far. In the end, you need to stick to the plan and do not make emotional decisions in your long-term trading account. Focus on the end goal. Okay, so what do we have for dinner tonight? Well, this isn't really dinner. This is one of those side dishes that we've been talking about, the side salads. This is watermelon tomato. It's a classic, right? It's refreshing and delicious. The colors and the freshness of this chilled salad make this a summer dinner table pleasure to look at, and more so, a delight to eat. If you have never had this salad, you have to make it. And if you've had it, you can appreciate the simplicity of it. Okay, so for this you need those fresh garden tomatoes, right? The nice big beefsteak tomatoes, either from the garden or you go to the produce store. You need mint, fresh mint, watermelon, feta cheese, salt and pepper, olive oil, and a splash of balsamic vinegar. You want to cut the tomatoes in half and then slice the halves into slices, right? You understand what I mean, right? You're making wedges out of them, right? Then you're going to cut up the watermelon, cut it away from the rind, and then cut it out into cubes, big enough just to eat, not huge, big enough that you bite size, right? Put those in a large bowl. Now add the tomatoes with the watermelon. Add the crumbled feta cheese and the chopped fresh mint. Drizzle it with a little bit of olive oil and a splash of balsamic. Season it lightly with salt and pepper, right? You can also hit it if you want with just a smidge of sugar if you want. I think that's more just psychological than anything else. But hit it with a smidge of sugar. Mix it. And then cover it and put it in the fridge to get it nice and cold, because this is really a cold summer salad. And then when you take it out ready for your barbecue or for dinner, just take it out 5 minutes ahead of time, because you don't want it to get room temperature. You still want there to be a chill in it when you're eating, because that's what makes it really delicious. In any event, the day is about to get started. So today and tomorrow is going to be full of economic data and, more churn in the markets. And I wouldn't be surprised if we see the market trade lower. In fact, I would like to see the market trade lower. I've said that to you. I think the 3950, 4,000-ish range on the S&P is about probably where we go, which is down, 400 points from here. Because we closed it, where we closed it, 44, 46 or something last night. So if we trade down to 4,000, that's a 400-point move, which is like a 10%. Might be somewhere between 8 and 10% move, I think is probably fair. And actually something that investors should want, right? Especially the long-term investor, because then they'll be able to scoop up some more bargains. In any event, the day has just begun. It's going to be a gorgeous day here on Cape Cod. I hope you're in a place where the weather is fine. Until tomorrow, take good care.